Hello students, welcome to all of you Shiksha 360. Today we have to discuss the chapter number 16 part 2. So let's start our discussion. So first of all we have to discuss regarding here, that is treatment of the loans or overdrafts facilities in the event of change in the residential status of the borrower. Like earlier person it is the resident of India, later that person basically shifted to the another country. That is the case. So in case of a person who had availed of loan or overdraft facility while a resident in India and who subsequently becomes a person a resident outside India. The authorized dealer or bank may at their discretion and commercial judgment. Clear? So the authorized dealer and bank may at their discretion and commercial judgment allow continuance of the loan or overdraft facility. In such the cases, the payment of interest and the repayment of loan, clear, in such the cases the payment of interest and the repayment of loan may be made by the inward remittances, clear. Okay, so in such cases the payment of interest and the repayment of the loan may be made by the inward remittances or out of the legitimate sources in India or of the person concerned. Next one, that is payment of funds to the non-resident nominee, clear, on the death of the account holder, clear, non-NRE account holder. The nominee can be the resident or non-resident, clear. So nomination facility, it is to be provided in respect of individual's NRE account holder. Nominee can either be the resident in India or a resident outside India. So the amount due or payable to the non-resident nominee from the NRO account of a deceased account holder shall be credited to the NRO account of the nominee with an authorized dealer or bank in India. Okay, that is to the NRO account holder of a deceased, the amount of the from the deceased account holder. In the case of the non-resident nominee, the amount payable to the resident nominee from the NRO account of a deceased account holder, if the nominee is a resident, shall be credited to the resident account of the nominee with the bank in India to be here. So that is regarding the payment of funds to the non-resident nominee. Next one, operation of NRO account by the power of attorney holder. There are also restrictions on that. Now let's discuss regarding that. All local payments in rupees, including the payments for the eligible investments, subject to compliance with the relevant regulations made by the Reserve Bank. Clear? All local payments in the rupees, including the payments for the eligible investments, subject to compliance with the relevant regulations made by the Reserve Bank. Second one, remittances outside India from the current income in India of the non-resident individual holder, net of the applicable taxes. The resident power of attorney holder, it is not permitted to repatriate, that is to transfer funds outside India held in the account other than to the non-resident individual. Clear? Only to the account holder they can transfer funds outside India, not to any other person. Clear? Not to any other person. This has not the power. Or not to make payment by the way of gift to a resident on behalf of the non-resident account holder, or transfer funds from the account to the another NRO account. Clear? Or transfer funds from the account to the another NRO account. These are not the powers to him. Next one, that is the international credit card. Very, very important. Authorized dealer banks have been permitted to issue the international credit cards to the NRIs or PIOs without the prior approval of the Reserve Bank. Such transaction may be settled by the inward remittances. Clear? That is the payment to the credit card. Clear? Or out of the balances held in the card holder, FCNRB, NRI or NRO accounts. Clear? Depend upon case to case here. Next one, that is the income tax. Very, very important. The remittances, that is net of applicable taxes, will be allowed to be made by the authorized dealer banks on production of requisite required information in the formats prescribed by the CBDT, that is Central Board of Direct Taxes, Ministry of Finance, Government of India, from time to time. First one, that is reduction of TDS for NRO account tax treaties, clear, as per the tax guidelines. So according to the Ministry of Overseas Indian Affairs, India has the second largest diaspora in the world. The overseas Indian, that is basically the Indian community in the world, clear, has the second largest. The overseas Indian community estimated at over 25 million is spread across every major region in the world. Liability to pay tax in India does not depend upon the nationality or domicile of the taxpayer, but on his residential status. Clear how the residential status is to be calculated? Residential status, it is determined on the basis of physical presence, that is the number of days of stay in India in any year. For the purpose of Income Tax Act, residents in India require stay in India of at least 182 days in a calendar year. Clear? If the government want to take taxes from any person that is earlier resident outside India, now it is residing in India. So that person has to stay in India for at least 182 days in a calendar year, or 365 days spread out over 4 consecutive years. Clear? Or 365 days spread out over 4 consecutive years. According to that, any Indian citizen who does not meet the criteria as a resident of India, it is a non-resident of India and it is treated as NRI for paying the income tax. In case of an NRI who is earning salaried income abroad, only income occurring in India or received in India or deemed to occur in India is taxable in India, unlike in the case of a resident whose worldwide income is taxable in India. Clear? Basically, the person who is residing in India, its total income, it is to be taxable in India. So therefore, for an NRI who earns abroad, it is very important to ensure that his or her salary, it is not received directly in India, so that it is not taxable in India. In a recent decision by the tribunal, NRI who earns abroad and receives salary directly in India, Indian bank account, can claim not to be earned in India. So this decision will help many NRIs who are traveling abroad in different country and have a bank account in India. Okay, very, very important. Because on that amount, they have not to pay any tax. So taxation of NRI and TDS applicability of NRO NRE account. The interest earned on an NRO account as well as the credit balance in account are taxed under the account holder tax bracket in India. The bank will upfront deduct 30% TDS on interest income, which an NRI can file its return and claim refund if he is falling within basic exemption limit. On the other hand, interest earned on the NRE account, it is totally exempted. Clear? That's why many persons, basically who are eligible for the NRE account, that is external, is totally exempted from the income tax and no TDS is deducted on it. And the credit balance in the account do not attract any wealth tax. Presently, there is not any tax regarding that. Earlier, this is the tax. So tax treaties, that is agreements. Many countries have entered into the tax treaties, also called as the DTA, that is double tax agreements, with other countries to avoid or mitigate double taxation. Such treaties may cover a range of taxes, including the income taxes, inheritance taxes, value-added taxes, or other taxes. Besides bilateral agreements, multilateral treaties are also in place. For example, European Union countries are parties to a multilateral agreement with respect to the value-added taxes under species of the EU, European Union, while a joint treaty on mutual administrative assistance of the Council of Europe and the Organization for Economic Cooperation and Development, that is OECD, is open to all the countries. Tax treaties tend to reduce taxes of one treaty country for residents of the other treaty country to reduce the double taxation of the same income. Clear? So tax treaties basically tend to reduce taxes of one treaty country for residents of the other treaty country to reduce the double taxation of the same income. The provision and goals vary significantly, with the very few tax treaties being alike. Most treaties for all the ethics in banking and foreign exchange facilities for individual sessions or special courses, you can join our batch. All details are to be mentioned here. For any other query, you can mail on our mail ID. Okay. So, what are the most treaties are to be here? Most treaties basically define which taxes are to be covered and who is a resident and eligible for the benefits. Second one, that is reduce the amount of taxes withheld from the interest, dividends and royalties paid by a resident of one country to the resident of the another country. Limit tax of one country on business income of a resident of the other country to that income from a permanent establishment in the first country. Clear? That is limit tax. Clear? That is limit, it is also imposed. Clear? That is up to this much amount you have to tax. Limit tax of one country on business income of a resident of the other country to that income from a permanent establishment in the first country. Define the circumstances in which income of individual resident in one country will be taxed in the other country, including salary, self-employment, pension, and other income. provide for exemption of certain types of organizations or individuals, or provide procedural frameworks for the enforcement and dispute resolutions. So the stated goals for entering into a treaty often include reduction of the double taxation, eliminating tax evasion, and encouraging cross-border trade efficiency. Very, very important for the examination point of view. What are the stated goals for entering into a treaty? Basically, often a reduction of the double taxation, eliminating tax evasion, and encouraging cross-border trade efficiency. So it is generally accepted that the tax treaties improve certainty for the taxpayers and tax authorities in their international dealings. Several government and organizations use model treaties as the starting points. Double taxation treaties generally follow the OECD model convention, and the official commentary and member comments thereon serve as a guidance to the interpretation by each member country. Okay, other relevant models of the UN are the UN Model Convention in the case of treaties with the developing countries, and the US Model Convention. US, UN, and this one the US in the case of treaties negotiated by the United States. Clear for the US? United States, that is the US Model Convention, and in the case of the developing countries, UN, United Nations Model Convention. Tax residency. In general, the benefit of tax treaties are available only to the tax residents of one of the treaty countries. In most cases, a tax resident of a country is any person that is subject to tax under the domestic laws of the country by the reason of domicile, residence, place of incorporation, or similar criteria. That is tax resident. Permanent establishment. Most treaties provide that business profits, sometimes defined in the case of treaty, of a resident of one country are subject to tax in the other country only if the profit arises through a permanent establishment in the other country. Clear? It depends, clear, where you are getting the profit. Clear? If you are also office in the other country, or basically are getting profit from the other country, so in that case, you are taxable to the other country, depend upon case to case or as per the guidelines. Okay, so tax residency, permanent establishment. Next one, withholding taxes. Many tax systems provide for the collection of tax from the non-resident by requiring payers of certain types of income to withhold tax from the payment and remit it to the tax authorities. Clear? Only after taking the tax, they will remit the money. So withholding arrangements may apply to the interest, dividends, royalties, and payment for the technical assistance. Clear? So where the withholding basically apply? Withholding arrangements basically may apply to the interest, dividends, royalties, and payments for the technical assistance. Most tax treaties basically reduce or eliminate the amount of tax required to be withheld with respect to the residents of a treaty country. Clear? To be withheld with respect to the residents of a treaty country to be here. Next one, that is income from employment. Most treaties provides mechanisms eliminating the taxation of residents of one country by the other country, where the amount or duration of performance of service it is minimal, but also the taxing the income in the country performed, where it is not minimal. Clear? Where it is not minimal. Okay. So most treaties also provide special provisions for the entertainers and athletes of one country having income in the other country, though such provisions vary highly. Also, most treaties provide for limits to the taxation of pension or other retirement income. Okay, like you are earning money from the other country in the form of a gift. Clear? So whether that money will be taxable in your country or not, so it depends upon the guidelines. Clear? Like you are winning any tournament in any foreign country and you are getting money from that country. Clear? And that money will be reaching to your country. Clear? Through your bank account. Clear? So whether that income will be taxable or not depend upon case to case. Clear? That is the income from the employment, or we can say that like winning prize money, all these things. Like here, special provisions for the entertainers and athletes of one country having income in the other country, like anyone performing or doing the concerts in the other country, like here presently like Diljit is doing concert in the other countries. Clear? So that is the income from the other country. Clear? How it will be taxable. Clear? All the guidelines it is to be mentioned here specifically. Tax exemptions. Most treaties eliminate from the taxation income of certain diplomatic personnel. Most tax treaties also provide that certain entities exempt from tax in one country are also exempt from tax in the other. Entities typically exempt includes charities, pension trusts, and government-owned entities. Many treaties provide for other exemptions from taxation that one or both countries are considered relevant under their governmental or the economic system. Next one, harmonization of tax rates. Tax treaties usually specify the same maximum rate of tax that may be imposed on some types of the income. As an example, a treaty may provide that the interest earned by a non-resident eligible for benefits under the treaty, it is to be taxed at not more than 5%. However, the local law in some cases may provide a lower rate of tax irrespective of the treaty. In such cases, the lower rate prevails. Clear? That 5% it is the maximum. If any country say that they will charge the lower rate, it depends upon that. But 5% it is the maximum rate that they will charge you. Double tax relief. Nearly all tax treaties provide a specific mechanism for eliminating it, but the risk of double taxation it is still potentially present. This mechanism usually requires that each country grant a credit for the taxes of the other country. Grant a credit for the taxes of the other country to reduce the taxes of a resident of the country. The treaty may or may not provide mechanism for limiting this credit and may or may not limit the application of local law mechanisms to do the same. Clear, it depends, and they have to take care also. Mutual enforcement. Taxpayers may relocate themselves and their assets to avoid the paying taxes. Some treaties thus require each treaty country to assist the other in collection of taxes and other enforcement of their tax rules. Clear? Like taxpayers may relocate themselves and their assets to avoid the paying taxes. Clear? Or we can say that tax evasion. Like person resident in India basically for 180 days. After that, they will move to the foreign country. Clear? To not to pay the taxes. So most tax treaties basically include at a minimum requirement that the country exchange of information needed to foster the enforcement. Clear? Country exchange of information needed to foster enforcement. So that is regarding the taxation in of NRI and the tedious applicability of NRO NRE account. Okay. So it leads to the completion of the topic. So thanks to all of you for joining this discussion.